Okay, so now we will discuss about what is a sharp turn. Okay, so sharp turn, this is a sign of reversal. Okay, so if we say for suppose example, okay, it can be any liquidity level. Okay, so here we have the inducement. Okay, so here we have the inducement. Okay, so the market was moving to the upper direction. Okay, the market was moving to the upper direction. Okay, so this has been mitigated the inducement. Okay, so this has mitigated the inducement here. Sharp turn means that it has a gap out and then the gap in. Okay, so if this level, okay, if this level has been breakout with the gap like this, so it can also be any liquidity level, not only the inducement level. Okay, not only the inducement level. So like this, so like this. Okay, so we have the gap here, it has breakout. Okay, the gap here, this is the gap, the gap. Okay, whatever gap it may be. And also we have the gap here. Okay, this is the gap. Okay, so this gap, okay, I think it's visible. Okay, so like this. Okay, so it has breakout this gap, mean that this liquidity level with the gap out and then gap in. So this is called as the V turn, okay, or the sharp turn. So this is the sign of reversal. So if you get any type of this sharp turn, okay, it is a sign that the market will reach up to this, reach up to its target. So it is the sign of reversal if there is any. And then if there is also sharp turn, then it should have also break out this, the left side, this first gap, because this will be the manipulation. See, it has reached the target. So after reaching the target means the first gap is manipulation gap, right? So this will be the manipulation gap. Okay, so it must have break this gap. Okay, so that you can take rate, and then it is also the indication that it will reach up to its target. Okay, if there is any sharp turn. Okay, so the same also applies to the uptrend and in the downtrend as well. So for suppose, okay, we have, let me just delete this one. Sharp turn means it can be like this also. But then if the gap, okay, if one gap is here, the another gap is here, one gap is here, another gap is here, this is not sharp turn. Okay, it has to be around at the same level. If one gap is here, the other gap should be around here or here. Okay, just nearby. So we can consider it, that as the sharp turn. Okay, so if there is a sharp turn here, okay, so the market has reached the inducement. So after reaching the target, this first gap is the manipulation gap. Okay, manipulation gap. So if the market come and mitigated this gap, okay, bullish, mitigated, and then got a rejection from here, and then it has also, like we have discussed, swept the liquidity of the previous mitigation candle. Okay, this is just an example to give you. So here the market has mitigated, prices mitigated the gap. We have discussed that if there is the swap, we can take rate. Okay, but here this is the manipulation gap. Okay, the first gap. So this is the manipulation gap. So even if there is swap, you cannot take rate in the manipulation gap. Okay, in the manipulation gap. So we have the sharp turn here. It has break out the manipulation gap. Okay, so manipulation breakout, we have the sharp turn. So this is an indication. So you can take rate from here because your target is here. Okay, so that is about the sharp turn. It is a sign of reversal. Okay, so we can also discuss about the strong and the weak gap at the liquidity level. Okay, so let us just select this one. Okay, so again, let us just draw the structure of the market again. I hope you are understanding well the structure of the market. We are drawing every time the structure of the market. So here, okay, it can be the any liquidity level, okay, but I'm just taking the example of the inducement here, but it can be the any liquidity level. So this is the higher high, okay, this is the inducement. So higher high, our inducement is here, okay, so our inducement is here. So after mitigating the inducement, okay, so this inducement has been mitigated, okay, the inducement has been mitigated it from a gap, okay, like this. Okay, so let's say this is the bullish candle, it from a gap. Okay, so is this a strong gap or the weak gap? Weak gap. So for me, this is a weak gap, okay, because it did not mitigated any fair value gap or order block, okay. So only after mitigating the inducement or only after mitigating the liquidity level, the first gap will always be the weak gap, okay. So we have the gap here. So this is the for suppose fair value gap, okay. So there is the probability that this gap may also fail, okay. This gap may also fail because this is the weak gap and it can also break out this gap, okay. Been mitigated below, or if no swing, so if there is another swing, okay, another swing and it has been swept for multiple times, like we have discussed on our the liquidity class, that if there is swing and then swept for the multiple times, then even the first gap will be the strong gap. But then if it did not sweep, and if swept only one time, and then that first gap will be the weak gap, okay. That will be the weak gap, okay, and it can also break the gap, okay. So but then for suppose we have the fair value gap here, we have the fair value gap or the order block, whatever, okay. So if the market mitigated any of this liquidity, fair value gap, order block, okay, this has the higher chance of holding your trade, okay. So if there is the breakout gap, you can place your trade directly to the upper direction, or if there is the fair value gap, you can take trade after the mitigation, okay. And then also, okay, and then also here, if the market mitigated the gap, okay, so this fair value gap has been mitigated, so this is the say bearish, so this fair value gap has been mitigated, okay, and then created another gap, created another gap to the upper direction here. So it has created another gap, okay. Okay, so this will be the strong gap, strong gap, okay, strong gap. So the fair value gap, this gap, the first gap has been mitigated, it has also created another gap, then this is the strong gap, okay. So this is the strong gap, so you can take rate depending on the type of gap, okay. Okay, so after, okay, so also after mitigating the gap, if the market or the price did not make any gap, okay, it did not make any gap, then the market will behave in the consolidation type, okay. It will just be like consolidating like this, okay. So if the market mitigated the gap, it did not break any gap, then it is an indication that the market did not have any strength, so it will just be clumsy and then type of consolidation, okay. So if it mitigated the gap, created another gap, which is also a sign that the market wants to move to the upper direction, and this will be also be the strong gap. So whatever that we have discussed, the same concept also applies to the downward direction as well. Okay, so we will discuss about the support and resistance trap. Okay, so this is not the strategy, but this is just the analysis, okay. So with time, then you can also identify the potential trap as well. So let me just explain, okay. Okay, so the market was moving like this, okay. The market was moving like this, okay. So here, this will be the support, okay, and this is the support area. So this is the support area, okay. So after multiple touch, okay, which means that this will be the support, okay. So if the market for suppose the market break this support level, okay, break this support level, okay, and then the market come and mitigated the this one, okay, this one, okay. So which means that what the price action trader think is that this support has been break out. After the breakout, if we come here again, this will act as the resistance, right? So what they will do is they will look for the sell break here. But then if there is any gap here, okay, if it is reversing from any extreme fair value gap, okay, any extreme fair value gap or any gap, then if there is the gap here, okay, so for suppose we have the fair value gap here, and then the market come and mitigated this fair value gap, okay. So what they think is that this support after the breakout, this will become the resistance, so they will look for the sell break here. So this is the confirmation for them, but then the market has already mitigated the extreme fair value gap, okay, and then it is also creating a gap. So what the market will do is that most of the time the market will went up here, okay, most of the time the market will went up here, and then those who place their sell break here will lose, okay. So this is how the market will trade you, okay, but there should not be any strong fair value gap at this cycle as well. So with time you will able to identify these things, so this is how the market can also trade you, okay. Okay, so I will give you another example. If the market was moving in an upward direction, okay, so here the market was moving like this is the inducement, okay. So for suppose let me just, okay, so wait, okay, okay, sorry. Okay, so this is not only at the inducement level but at the liquidity level, okay. So at the liquidity level, I'm just taking the example of the inducement here. So the market is coming down, the market it's coming down to the downward direction, okay. So here the market is coming down, so let me just make this one like this, okay, so that we have more space, okay. So like this, this is the wick of the candle. I think it's visible, okay. So the liquidity will always be at the lowest point, right? So at the lowest point of the candle, okay, so it will always be at the lowest point. So our inducement level is here, okay. So the people think that if the market come here at this support level, okay, if there's the support level here, and then the market got an type of engulfing pattern here, okay. From this is the, okay, this is not the breakout gap, okay, this is the support, got an engulfing pattern at this or whatever confirmation they get, okay, at this level, at this support level. So what the thing is, after this engulfing pattern, the price action trader or many traders, they may think that, okay, this is the support level, the market is giving us the engulfing pattern, we will go up on the next candle. But then what the market will do is it will always go down, okay, most of the time. So it will come down, like this, okay. So because if we look at here, this is the liquidity level, the liquidity is not being swept yet, okay. the liquidity is not being swept yet, but then there should be the gap here, okay? There should be the gap here, okay? So this is the gap here. So the thing that this is the support level. So after giving an engulfing pattern, the market will went up because it's a trend, but then the liquidity is at this level. The liquidity is not being swept yet. So most of the time the market will reverse, okay? So this will grab the credit. So those who have placed their buy trade here will lose. So what is the engulfing rule? After this candle close at this 50% level, okay, this is the engulfing rule. They will place their trade MTG to the upper direction here again, but then the market will most of the time move to the downward direction here, okay? The market will most of the time move to the downward direction here, okay? So this is how the market will grab the traders because the liquidity is here. It did not sweep yet, and then the market is creating a bearish gap, got in a rejection from the gap, okay? So most of the time the market will went down to sweep the liquidity, okay? So anything without liquidity is a crap, okay? Anything without liquidity is a crap, okay? So I hope you understand, okay? So but then however, if there is any if we have any gap at this area, for suppose we have the fair value gap at this area, then the market can also move up, okay? Then the market can also move up, okay, if there is any gap, because gap is the liquidity, and then this has already mitigated the gap, so which means that the market can also move up, okay? So this is about their crap. That's how the market can grab you, okay? So this is not only at the inducement level, okay, but at the all day liquidity level, okay? This is how the market can grab you. Okay, so we have almost come to the end of this course, and I will also show you some of the examples I've taken, and we can discuss more. Okay, so here, if we look at here, this is the extreme gap. So extreme gap means the market reverses from this gap. This is the gap here, but then after mitigating the extreme gap, if there is the gap, we have discussed that it will be the reversal point, right? So this is the reversal. So reversal, so even if there is mitigation, we don't take break, okay? But we don't take break, okay? And then here, the first gap, okay? This is the first gap. After mitigating this extreme gap will be the manipulation gap that we have discussed, right? So this is the manipulation gap, and then it has created a gap here again. And then what is this? This is sharp turn now. This is sharp turn now. So the left side gap is the manipulation gap. So see, this has break out the manipulation gap. So where is our target? This low will be our target. So breakout gap. What is the rule of breakout gap? If the third candle is good, we can take trade. So see, we have taken the trade here because we still have room available. So this is the winning trade, right? So this is how you can analyze the market, okay? I will show you more examples. Okay, so here also see, this is the liquidity level, and then the market has grabbed the liquidity here. It has created a bearish gap here indicating the downward movement, and then also another bearish gap here. So see, and then this is also another bearish gap here. So see, this is the support level. So the market is creating an engulfing pattern here. So we have discussed it. This is the engulfing pattern. Most of the traders, they will went up, but then we have a gap here, and then the liquidity is not being swept yet. So what the market will do, see, it will always move down to take the liquidity, okay? So this is the crab. This will be the crab candle. This is how the market can also trap you, okay? And then I will also give you more examples, okay? So see, this is the gap here. It has been mitigated. So means gap, after mitigating the gap, if it created another gap, we discussed that it will be the strong gap, right? So here, mitigated the gap here, created another gap here. So this is the strong gap. So this is the first target. So our target here has been breakout. So which will be our target now? So this wing will be our target number 2. So we still have room available here. So see, this is the breakable gap, third candle good, we can take break to the upper direction. So see, this is the break candle, this is the winning trade, right? So see, if you analyze the market like this, then you can also take break like this by analyzing the market. Okay, so here we can also discuss again. So see, we also have discussed the gap is the liquidity. So it has already mitigated the gap, the liquidity has been swept, which means, and then also the market is created the gap here. So this gap, this bullish gap did not respect that, it as a breakout. So after the breakout means this will become the inverse fair value gap, inverse fair value gap plus the fair value gap. So see, got a rejection from the inverse fair value gap and then fair value gap. So the target is here. So see, the below is the target, we still have room available. So see, this is the winning trade. Okay, so that's how you this is how you can analyze the chart, and then you can take click. Okay, so see more examples here. So see more examples here. This is the breakable gap here, another breakable gap here. So this is the target. Okay, this is the first target. Okay, so our target has been breakout here, this is the target has been breakout here. So this will become the inverse fair value gap now. So inverse fair value gap plus FVG plus we also have the breakable gap. So we have many plus points. So this candle is within the rejection from the inverse fair value gap, and also this third candle is an unusual candle. So this is the long candle here, so we have to wait for the retracement, right? So if we have also discussed that if the candle is unusual, wait for the retracement. So retracement here, after retracement the candle went up here. Okay, we'll give you more examples here. See, it has mitigated the gap, the market has went up, and then it has also created the gap here. So see, this is the fair value gap. So see, after mitigating the liquidity has been swept, the previous mitigation candle liquidity has been swept here. So after sweeping, the market went up here. So see, okay, here also see it has created the gap. So this target has been breakout, so this will be our next target here. So it has been mitigated, so mitigating after sweeping the mitigation candle, see the next candle went up here. Okay, so you can see here. Okay, so here also see, this is the swing high, this liquidity has been swept here already. We have the gap here, this is the gap, so this is the gap here, so which means that this is the sharp turn, right? So this is the sharp turn, and then if we look at here, this is the breakaway gap here. So this gap will be our first target, so we still have some room available here. So if you take break here, you can win the break here. Okay, so this will be our second target. Okay, so this is about it, and then I hope you get to understand. And on the next class we will talk about the setup explanation and some of the important psychology, and then how you can also check the currency pair and as well. Okay, so